Welcome to the Video CPA. I'm Michael Scott. I am the Video CPA and a CPA of 46 years doing tax work. We talk about tax and accounting on this channel. And so today we're going to talk about the Earned Income Credit and help you understand the Earned Income Credit. This credit's been around for a long time, and most of you take it every year. If you're not taking it, you should if you're eligible. So we're going to talk about which people are eligible to take it and which kids qualify to be added and take the credit. And then some of the due diligence requirements that your tax preparer faces to prepare for this credit, and some preparation that you ought to do as well if you're preparing your own tax return. So let's get with it. We've got our disclaimers here, and you've seen those if you've been watching this channel. So an educational disclaimer and a affiliate marketing disclaimer. So what is the credit? Okay, the credit was actually designed for low and moderate income people to give them a little bit more money at tax time. And it is a refundable credit, so even though you may not have paid anything in during the year, you still may get a refund because that credit is refundable. Originally designed for people with children, now actually people without children, if their income is in the proper range, can actually get a credit as well. So it has changed over the years a little bit, but primarily designed for low income and moderate income families with children. All right, so let's look at what the rules are, and there's quite a few rules that you have to abide by to be able to qualify for this credit. And the first one is you have to have earned income, all right? And you have to have earned income within a particular range. So we'll talk about what earned income is and what that range is a little bit later on a later slide. But that is the major requirement, that you've got to have earned income. If you don't have any earned income, you don't get a credit, okay? Second one is that your investment income, and we will define investment income on another slide, has to be under $3,650 for the year that you're applying for the credit, okay? If it's over that, no credit, all right? You also have to have a Social Security number. Individual taxpayer identification numbers that are issued to aliens in this country do not qualify, so it's got to be a Social Security number. And you've also got to be a resident of the United States or a resident alien for the entire year that you're claiming the credit, okay? In addition to that, if you file married and separate, you're not going to get a credit. You can get a credit if you're single, if you're head of household, if you're married filing jointly. But if you file married and separately, you're not going to get a credit. So just be aware of that. And I mentioned the U.S. citizen and the resident aliens for the entire year. And you cannot have filed during the tax year that you're applying for the credit a application for credit on 2555, which is the foreign income tax credit. And then the last thing is that you need to realize that only one taxpayer can take this credit. It can't be taken by your spouse, and then it can't be taken by your ex-spouse, and then you take it as well. So only one taxpayer can take the credit. So you have to determine whether you qualify for the credit, and if you qualify for the credit, take it. If somebody else takes it the same year, like an ex-spouse or something like that, that's sharing the kids, then the IRS is going to flag probably the one that files their tax return second, and they're going to have to prove that they've got a right to take it, and it'll be fought out between you and the IRS, between the two of you and the IRS. So not a good situation in that type of thing. All right, so those are the basic rules that you have to abide by in order to qualify to take the credit, to be eligible to take the credit. Now, let's look at the first two a little bit more in depth and see what earned income is, okay? So earned income is going to be wages, it's going to be self-employment income, it's going to be some types of disability income, going to be non-taxable combat pay, and certain strike benefits, okay? those are examples of earned income. Earned income is income that you've actually worked for in some way, okay? Now, the IRS gives you specific examples of what is not earned income, okay? So if you happen to be in prison and you work and earn income in prison, that is earned income, but by statute that's not going to qualify for the earned income credit, all right? So be aware of that if you're in prison. Also, interest and dividends, pensions and annuities, capital gain type income, Social Security, unemployment benefits, alimony, child support. None of this type of stuff is really what we think about as earned income, and it's not earned income for the credit. So this will not qualify you to take the credit. And again, if you don't have any earned income, there's no credit that you can get. So earned income, again, wages, things that you work for, self-employment, that type of thing, all right? Okay, so what is the earnings range then if you've got earned income? And let's just look at this, because if you're married and you have 2 kids, for example, and you make over $53,865 in income during that year, and that's your maximum AGI, your adjusted gross income. If you make more than that, you're not going to qualify for the credit. If you make that or just under that, you'll qualify for maybe a small credit, okay? So if you don't make anything, you don't get a credit. If you make over the $53,865 and you're married with 2 kids, you will not get a credit either. So the credit actually peaks kind of in the middle of those 2 numbers, between the 0 and the $53,865. And then it starts going down on the other side of the midpoint, generally, okay? Now, you'll notice at the bottom there, it says the $3,650, and these are 2021 numbers coming up for you. No qualifying children. If your income is in the right bracket, you'll have $543 worth of credit. In the example that we mentioned, with 2 qualifying children, you'll have $5,980 worth of credit. If you're, depending on where you are within that range, that's the maximum that you're going to get, okay? And you've got to be at the right place in the range. But those are the tables, so it's a pretty easy calculation. I mean, you count your children and count the way your filing status is and look it up on the table. Look it up on a table, and it'll tell you what your credit is. And of course, with tax software, it does it automatically. So if you're using TaxSlayer or TurboTax or something like that, it's going to do it automatically for you. All right, what constitutes then investment income? Because we noticed, or we told you that if you have investment income of $3,650 or more, you're not going to get a credit, okay? So let's look at this. So capital gain net income, for example, from sales in stocks and bonds, or sales of a personal, a rental property, for example, residential rental property, or some type of real estate. Interest and dividends are investment income. Royalties and rental income on personal property, investment income. Income from passive activities, that would be rental income from real estate for the most part, unless you've got a real estate business. And if you've got a real estate business, that would qualify as earned income, actually. But most people don't have that, and so most rental income on real estate is a passive activity, and it's going to constitute investment income. And then Alaska permanent fund dividends for you and your children. And I forgot to mention, but the interest in dividends is also for you and your children. So you add all that stuff up. If it's over $3,650, you're not going to get a credit. So pay attention to that when you're looking at whether you're going to qualify for an earned income credit or not. All right, the next thing to look at is the rules for children. In the example we looked at, we said this guy was married, filing a joint return, and he had 2 kids. Okay, well, those kids have to be qualifying children. So let's look at how you determine whether a child qualifies or not. And there's really 4 aspects of this, okay? You look at age, You look at relationship, and you look at whether they're filing a joint return or not, and you look at residency. Okay, so we're going to look at each one of these in a little bit more detail. So with age, if, for example, you have a child that's permanently disabled, they can be any age, and they will qualify for the credit. If they're under 19 and they're younger than you or your spouse, all right. Now, some people must marry child brides or something, or child husbands or something, because this obviously happens, or the IRS wouldn't put this language in here. So if you've got a child under 19 and he's younger than you or your spouse, you can claim him on the credit, okay? If, for example, he's a full-time student, he or she, and he's under 24 years old, and he's still younger than you or your spouse, well, then you can still take it. You can take him for the credit, all right? So you just got to make sure you're not marrying any children there that are younger than your own children. And like I say, this must happen. Okay, I've never ran into it before. All right, so that's the age test. And yeah, they have to meet the age test, and then there's a relationship test. And the relationship test basically says that it's got to be a child, a son or a daughter, okay, a stepchild, or an adopted child, or a foster child. So the relationship test basically says that they've got to be related to you by blood, or they've got to be legally related to you in some way, okay? So an adopted child would be legally related to you, and a foster child would be too, if you're allowed to have that foster child in your home. All right, also brothers, sisters, half-brothers, half-sisters, step-brothers, step-sisters qualify as a qualifying child under the relationship test, or a qualifying individual, let's put it that way. And then a grandchild, a niece, or a nephew would qualify as a qualifying individual as well. So that's the relationship test. So the residency test, and basically the residency test says that this individual, this child, or this dependent needs to have lived with you in the United States for more than half of the year. So the United States is any of the 50 states. It does not include the Philippines or Puerto Rico, but anywhere in the United States. It does include Army bases if you're overseas. So there are nuances to this stuff that I'm not going to get into, that if you've got these types of situations, you need to look at them in more detail. But that's the main thing. They've got to live with you in the United States for more than half the year. If you have a child that died during the year, or that was born during the year, then the qualifier is that they have to have lived with you for more than their life during that year. All right? So if you have a child that died 3 months into the year, and you had them for 2 months out of that year, they would qualify for you. And so then the IRS talks about, as far as residency goes, time away from home for a dependent or a child. So basically they say that, hey, if the child is away at college, we treat them as if they're home. If they're in the military, we treat them as if they're home. If they're in a hospital for some reason, we treat them as if they're home. If they're locked up in a detention facility for juveniles, we treat them as if they're living with you at home, okay? And if they're kidnapped, we treat them as if they're living with you at home. Now, these are the examples that the IRS gives. There may be others. So if you got this kind of situation, and there is something peculiar as to why this child is away from your home, you need to go ahead and do a little bit more looking into it. But these are the ones, like I say, that are most prevalent, and most prevalent is away at college or in the military. All right, so So far we've talked about the age test, the relationship test, the residency test, and now we're going to cover a joint return test. Okay? Basically what the joint return test says is if you have a child and he files a joint return with his spouse and they apply for any tax credits, that child is not going to qualify for the earned income tax credit. You cannot take that child for the earned income tax credit. All right, so what the only exception to that is if the only reason that he's filing is to get his withholding back and he doesn't owe any tax, he just is filing to get the withholding back. Then he could go ahead and file a joint return. But in any other situation, if they're applying for tax credits or something like that, you're not going to be able to claim in for the investment or for the earned income tax credit. Okay? So, let's go ahead and look at the last thing, and that is you need to be aware of the due diligence requirements placed on tax preparers, because these things influence what you keep. If you do your own return and you take the earned income tax credit, you need to be aware that you need to keep some records so that if you're audited, you can defend yourself and as to why you took the earned income tax credit. Now, it also applies if you use a paid tax preparer. He's going to ask for some information. You're going to think, why is he asking for this? But tax preparers are, unfortunately, as tax preparers, we are becoming an arm of the IRS almost in enforcing tax law. I think the publicans in the New Testament that Rome hired to collect taxes. But they're trying to get us to be their enforcers in making sure that people are honest when we prepare the tax returns. So what this basically says that you see up on the screen is that any preparer that prepares a tax return and takes one of these credits, one of which is the earned income tax credit, they have to have abided by due diligence in order to take that. And if they fail their due diligence requirement, they can get penalized. So the penalty right now is $520 per instance, okay? So tax preparers can actually be penalized for not relying on documentation. And so they're going to come to you and they're going to ask for documentation. And you've probably noticed that in the past few years, because they need to have this in their files in case somebody is audited. They're going to get, if they don't have anything in their file, if we don't have anything in our file, we're going to get penalized. All right. So some of the things that we have to keep in our file are things like school records, medical records, landlord or property management statements that may indicate that the child lived with you, child care provider records that would indicate that the child was with you and you're paying child care for them. If it's a foster child, a placement agency statement maybe, or a social security, social service record, something like that. If you adopted the child, adoption records. Those things your tax preparers are going to need to see. And you're going to need to keep, if you prepare your return on your own, you're going to need to keep this type of information. Because if you are audited, and the IRS does look at the earned income tax credit much more carefully than what they have in the past. If you get audited, you're going to need this kind of stuff to support your claim. So make sure you keep that information. Make sure that if you're hiring a paid tax preparer, that that you're providing that information, or at least you're patient when he asks you for this type of information, because there is a real need for him to have it. He wants to make sure that you're qualified to take the earned income tax credit. All right? All right, well, I appreciate you watching. If you haven't subscribed to the channel, subscribe to it. We talk about a lot of different tax matters. Got quite a few videos out there now, and I'm producing a video about every week or 10 days, I guess. Especially during tax season now that it's started, it's going to be a little bit slower. But do appreciate you watching, and like the video if you like it, and thank you.